Walk me through what you thought of the decision and the statement in the presser, and whether or not you think financial stability or inflation is on the front burner right now.
So as you said, I did think they made the right decision. I think there's a huge amount of uncertainty going forward about how tight financial conditions are going to become as regional banks tighten up. Growth has moderated some, and labor markets show a few preliminary signs of moderating pressures, moderating vacancies are down, etc. But labor markets are still very tight. Core inflation has shown no sign of coming down from very elevated levels. So I think it's too early to call a pause on rates. You don't know what's going to happen, whether you need more, whether they are sufficiently tight. That depends on a lot on what happens in this banking sector. And because that's uncertain, I think they cannot promise raising rates again. So they're in the right place to deal with this uncertainty.
What do you tell those who fall back on the classic scald yourself in the shower argument that, yeah, the water's going to get hot, and by the time you keep that faucet open on the hot side, it could burn you? I mean, is that a legitimate narrative to spin right now?
It is, in the sense that we know there are lags in the effects of monetary policy and tightening financial conditions on the economy. But we don't know exactly what they are, and we don't know how tight financial conditions have to become in order to accomplish the Federal Reserve's objectives of getting inflation down to 2%. I think this situation is very different from a one in like 94, 95, or even 2006, 7, when you're really tightening policy to keep inflation from rising. Here we have inflation in the 4 to 5% range on core inflation. You've got a lot of room you need to take it down. So I do think they're right to be very, very cautious about signaling a pause, or even more cautious. Obviously, they've ruled out lowering rates. They need to see more progress on the demand side and on the price and wage side before they can declare the water to be too hot.
So it sounds like, Donald, you think that the Fed is putting inflation more on the front burner than financial stability. And on that latter topic, I just wanted to share with you a headline that crossed a short while ago, which is from the FT saying that Western Alliance is now exploring a sale. They cite people familiar with the matter. We haven't been able to confirm those headlines quite yet, but shares in Western Alliance, PacWest, other regional names down pretty sharply, very sharply on the week amid this turmoil. What do you think the Fed should be doing in terms of regulation, in terms of supervision? Do you think they're doing enough as this turmoil unfolds?
So to answer your question, right now there's not a conflict between financial stability and monetary policy, because the threats to financial stability are causing banks to tighten up credit, and that's what the Fed needs in order to get inflation down. Could that arise in the future? Sure, yes. But it'll arise in the context of financial stability undermining the economy, and that'll be a situation in which the Fed should be lowering interest rates if the economy freezes up, if the unemployment rate rises rapidly because businesses and households can't get credit. So I don't see a conflict right now. I think what's going to be very difficult is to judge how much effect the pullback in credit by regional banks will have on the economy. They need to be very alert to that, and alert to the possibility that it could be a sudden stop in credit for small and medium-sized businesses, in particular, dependent on those regional banks. So I think it's something they've just got to keep monitoring and reacting with policy to, because it will have effects on inflation. I don't think it's an either or that they need to choose right now.